There are many peaks and valleys in the stock market's past, but the primary trend direction has been upward. Investing in the market at any time will result in a positive return on your money in the long run. If you had invested at a market's peak in 2007 or 1999, you would have seen not just a recovery, but a tremendous growth. The market has expanded at a record rate since 2011. Meanwhile, in 2008, the Fed recognized that it can create trillions of dollars, dump it into the economy, and it will recover far faster than it simply waited for the market to correct and recover on its own. This strategy has worked quite well throughout the last two crises. However, the stock market crash of February and March 2020 stands out as a watershed event in the industry's annals. There has never been a more dramatic and immediate crash in the stock market. This fall is unlike any other since it bounced back so quickly and has been on an emotional roller coaster. Because this is so abnormal, many market watchers believe another crash is imminent. Even with the help of low interest rates, the market cannot climb by so much for no reason. But the mystery is, why hasn't the crash occurred yet? To what end is it expanding? And when can we expect it to stop? Welcome to Financial Path, and for today's video, we will be figuring out the answers to all of your questions about the stock market state so far. But before we go on, make sure to give this video a like and subscribe, and might as well hit the bell button while you're at it. But other than that, let's begin. If you have been keeping track, you'll know that the correction occurred in 2021, and the clever among you likely took advantage of it. It was an excellent opportunity to purchase, but it wasn't the market's first dip. We appear to be going through a downturn every few months, and each time it feels like the market is going to drop much further, it never does. We must realize that the last year or two had been the boom's peak. The economy begins to improve and expand rapidly during this time. The economy multiplies initially, then levels off as it reaches its total capacity. When inflation increases faster than economic growth, the Federal Reserve raises interest rates to their maximum to slow the inflation rate. However, doing so also restricts the flow of money in the economy, which means that economic growth is sluggish and only sufficient to keep up with inflation. The economy falls like a house of cards when the bubble finally pops. In 2008, 1999, and 2020, this occurred. When this happens, the Federal Reserve steps in with low interest rates and bond purchases to speed up the economic recovery. The economy typically returns to where it was before a crisis in the first year or two. After that, there is a period of rapid growth known as the boom, during which everything accelerates until it reaches its pinnacle. Then, it gradually declines until it inevitably collapses. This graph makes it so easy to see the current state of the economy. No one can predict the future, and we can guarantee that the economy won't fail, but there are usually a lot of warning signs. Since our economy is mainly driven by consumer spending, most people understood the Fed's decision to reduce interest rates to near zero. Consumer spending drives economic activity. As soon as they cease, everything stops. A simple collapse occurs. The Fed took the easy way out by artificially keeping the wheel turning while we were recovering from the pandemic. It appears to have done an excellent job, but it has been vague about when it plans to raise interest rates again. They've stated that they'll do whatever it takes to keep the economy afloat. That means maintaining interest rates low for not months or years but decades until the economy fully recovers. So while growth has slowed, at present rates, it can't possibly fall. Many experts predict rate hikes to occur in 2023, which is a pretty plausible timeframe. Anything can happen by then, but it seems to be the most likely scenario. The Federal Reserve is determined to increase interest rates. This inflation is unpopular across the board. The Federal Reserve Board repeatedly reassured the public that inflation was manageable even though actual inflation rates were significantly higher than the Fed had predicted. The expansion of the past few years only occurred with cause. This came at the expense of higher prices in the economy. Property prices in particular have risen dramatically over the globe. In most cases, factors other than the supply and demand contribute to a rise in home prices of 20 to 30%. Certainly not the norm. That's a whopping tenfold increase above their regular fee. No country is economically unconnected from China, and the United States is no exception. Therefore, the United States and the rest of the globe will feel the effects of a Chinese recession if one occurs. You have probably seen photographs of abandoned cities in China. The lack of accessible investment options is a significant problem in China. They have a stock market and major multinational firms like Alibaba, Tencent, and so on, but they are closely regulated by the state, which makes their future uncertain. While things are looking up for the company now, that might all change if the CEO were to get into a disagreement with the Communist Party. Consider Jack Ma, one of the most well-known Chinese businessmen. He vanished after criticizing the regime, taking about $11 billion in wealth. Since real estate appears to be the safest investment, most Chinese people invest their money. Prices in the real estate market tend to appreciate over time. They are unaffected by inflation and can be used to generate passive income. But that plan has backfired, as they have constructed far more homes than the country requires, leading to an enormous surplus of housing. An unprecedented 1/4 of homes remain unoccupied. In some areas, entire buildings have been demolished because they have been laying idle for so long, similar to a trend that emerged in the United States not too long ago. I've seen that an increasing number of Chinese people are purchasing their third home at the same rate they purchased their first. The 2008 market crisis was caused by consumers buying more homes than they could afford because of low loan rates and lax rules. I know I just simplified a lot there, but basically, that's what happened. No one knows when this bubble will collapse or how devastating it will be for the economy, but if it does, it could have repercussions worldwide, including in China. We are not on the verge of seeing a crash, and one hasn't occurred in the past year or two for the reasons we've already covered. Since knowing when the market will tank is challenging, dollar cost averaging is the safest way to invest. On the other hand, that's all we have for you today, and we thank you so much for watching. Do you agree so far with the things we just mentioned here in this video? Or do you believe that there is still another reason why the market hasn't crashed that much yet? Let us know what you think in the comment section below, and we'd love to hear more of your thoughts about this one. Other than that, this is a Financial Path, and if you'd like to see more of our future uploads, feel free to give us a thumbs up and hit the bell button and subscribe as well while you're at it to stay updated. Thanks again for watching, and we'll see you soon.